Welcome to Growth Wealth Code, where we explain investing concepts in a simple way. Have you ever opened your brokerage app, looked at two companies that both seem good, and gotten confused about why one of them slowly climbs while quietly sending you cash every few months, and the other one just skyrockets in price, but never gives you a single dollar? If so, you're not alone. This is one of the first questions almost every new investor eventually asks. In this video, we're going to break down what a dividend stock actually is, what a growth stock actually is, how each one really works with real numbers, and most importantly, which one might fit you better depending on your goals and your time horizon. But first of all, this video does not contain any financial advice. Everything we cover here is general education, not a recommendation to buy or sell any specific stock. Okay, let's keep it simple. Imagine you have two friends. The first friend, let's call him Consistent Carl. Every single month, without you even asking, he shows up and buys you coffee. It's not a huge amount, but it's reliable. You know exactly what you're getting and roughly when you're getting it. He's probably never going to make you rich overnight, but he also rarely disappoints you. The second friend, let's call him Bold Ben. He doesn't give you anything right now. Instead, he keeps saying, "Trust me, I've got a plan." Sometimes his plan actually works out, and he ends up far wealthier than Consistent Carl. Other times his plan falls apart completely, and you walk away with nothing. Consistent Carl is basically a dividend stock. Bold Ben is basically a growth stock. Now let's get into the formal definition. A dividend stock is a share of a company that regularly distributes part of its profits back to shareholders in the form of cash, usually every quarter. These companies tend to be more established, with stable cash flow and growth that's slowed down compared to their early years. So instead of pouring every dollar of profit back into expansion, they choose to share some of it with investors. A growth stock is the opposite. This is a company that chooses to retain almost all of its profits. Sometimes it isn't even profitable yet, and reinvests everything back into the business for research, expansion, or acquisitions. The hope is that the company's value grows dramatically over time, and that shows up in the stock price itself, not in cash payouts. So why does this actually matter for you as an investor? Because both of these paths generate returns in fundamentally different ways, and that changes how you should set your expectations. Let's look at some real numbers. Say you invest $10,000 in a dividend stock with a yield of around 3% per year. That means you could potentially receive around $300 a year in cash, completely separate from whatever happens to the stock price itself. You can take that cash out, or you can reinvest it to buy more shares. And this is exactly where the quiet power of compounding starts working in the background. Now compare that to a growth stock. You invest that same $10,000 into an aggressively expanding company that pays no dividend at all. For 5, maybe 10 years, there's no cash landing in your account from that stock. But if the company succeeds and doubles, or even multiplies its value several times over, the potential gain from that stock price appreciation can far outpace anything a dividend stock could ever offer. This is where a real case study helps. Think back to Amazon in the early 2000s. Amazon has almost never paid a dividend in its entire history. For years, the company reported losses on paper because every dollar was being funneled back into infrastructure, logistics, and expansion. Investors who held on patiently for 2 decades watched an extraordinary amount of value get created, far beyond what even the most stable dividend stock could have delivered. But along the way, there were sharp drops, including during the dot-com crash in the early 2000s, when many panicked investors sold at the very bottom. Now compare that to a company like Coca-Cola or Johnson & Johnson, which have paid and even increased their dividends consistently for decades in a row. Investors holding those stocks never saw dramatic price spikes, but they received a reliable stream of cash even during the 2008 financial crisis, when many growth stocks collapsed and gave investors nothing to soften the blow. But here's the catch. A lot of beginners assume dividend stocks are automatically safer and growth stocks are automatically riskier. The reality isn't that simple. Some dividend stocks are eventually forced to slash their dividend entirely during a downturn. This is called a dividend trap, where a yield that looks unusually high is actually a warning sign, because the stock price has already crashed first. And plenty of growth stocks turn out to be nothing more than an empty promise with no real fundamentals behind them, which is exactly what happened to countless companies that went bankrupt after the dot-com bubble burst. So what does that actually mean for your strategy? This isn't about which one is objectively right. It's about what you actually need from your investments. If you need reliable passive income right now, for example, to fund retirement or cover monthly living expenses, dividend stocks usually make more sense because they hand you cash on a regular basis without forcing you to sell your shares. If you're younger, have a long time horizon, and can stomach sharp price swings without panicking, growth stocks can offer significantly larger capital appreciation over the long run because you have the time to let compounding fully play out. Many investors don't pick one extreme or the other. Instead, they build a diversified portfolio that blends both, part dividend stocks for stability, part growth stocks for higher upside potential. Research from firms like Hartford Funds has even shown that over very long periods, reinvested dividends make up a significant portion of the total return of the stock market as a whole. So dividends aren't just a small bonus. They can quietly become a major compounding engine that a lot of people underestimate. I'm not saying one is better than the other, just pointing out that both work through very different mechanics, and the right fit really depends on your own financial goals. The most common mistake I see from new investors is trying to chase both at the same time without any real strategy. Buying a growth stock out of FOMO while it's rallying, panic selling the moment it drops, then rushing into dividend stocks because they feel safer without actually understanding what they just bought. This is exactly where discipline matters far more than trying to guess where the market is headed next. So the solution here is systematic, not a shortcut. First, figure out your goal. Are you investing for passive income or for long-term capital growth? Second, figure out your time horizon. The longer it is, the more room you have to ride out the volatility that comes with growth stocks. Third, don't put all your eggs in one basket. Diversification is still the foundation, whether that's through an index fund that already blends both types, or a manual combination that fits your own risk profile. And finally, stay consistent. Dollar cost averaging still applies to both types of stocks, because showing up regularly matters far more for your long-term results than trying to time the perfect entry point. So, dividend stocks versus growth stocks, neither one is really wrong here. One gives you certainty and a steady stream of income. The other gives you the potential for much bigger growth in exchange for carrying more uncertainty along the way. Both are valid, depending on your goals, your risk tolerance, and your own investment time horizon. It's not about timing the market. It's about time in the market. And that's true whether you choose dividend stocks, growth stocks, or a mix of both. If you found this helpful, hit like and subscribe to Growth Wealth Code. And if you like this video, you'll probably like our video on index funds versus ETFs and which one makes more sense for beginners. See you in the next one.